right. So hello, everybody, and welcome to our webinar today. Today, we're going to run through the offering that Legend Real Estate Trust has currently available, and we're going to get into a couple other items today. So thank you, everybody, for joining us. We are going to start with a couple of housekeeping items just to make sure that we've got the functions of Zoom all set up and ready for you. This is going to be an interactive webinar, so if you guys have a question along the way, I want you to go ahead and pop it into the chat, or you can use the Q&A feature as well, whichever one that you prefer. So everybody, go ahead and let us know in the chat where you are joining from today. So I'm in Guelph, Ontario, is home office for us. So go ahead and let us know in the chat where you're signing in from. And this will give us a chance to make sure that we've got all of our settings figured out here as well. And just make sure that when you're typing your message, there's a blue box that's a drop down. If you want everybody to see your chat message, just make sure you've got everyone selected for that. Okay, amazing. Christina is joining from Fergus. Hello, Christina from Fergus. And we've got Wanda in Brampton. Welcome. And then we've got John in the Ottawa area. So Wanda and John, you've got your settings set to just sending your message to hosts and panelists. So if you want everybody to see your message, there's a little blue icon at the bottom of your chat with a drop-down menu. You can go ahead and select everybody, and then you can chat to everybody in the group. And we've got Human in West Vancouver. Excellent. Welcome. Thank you for joining. Great to see you. Verna is from the Sunshine Coast. Amazing. Welcome. I hope it's sunny there as well. Leela, hello. Great to see you from Victoria, BC. We've got Surrender from Mississauga. Amazing. John, it looks like you've got your setting fixed now to everybody joining from the Ottawa area. So everybody, once again, welcome to the webinar for Legend Real Estate Trust today. Okay, thank you. Good to see you as well. And we've got Wigan from Ottawa as well. So that's great. So I'm going to go ahead and share my screen and jump into our presentation here today. Okay. And my team, Christina and Sam, just jump in if you don't see my screen. Otherwise, I will assume that we are good to go here. I'm just going to pop into presentation mode. All right. So Legend Real Estate Trust, we are focused on acquiring high quality multifamily properties all across Canada. And we offer a really great passive investing option to all of our investors who would like to participate. So in today's webinar, this is our agenda. We're going to talk about our why and why people invest into real estate. And I'm going to share a bit more about how Marty and I got started and the reasons why we invest into real estate. We're going to get into a commitment for today. So that'll be a commitment for you guys to make to yourself today to get the most value out of today's webinar. We're going to go through Legend's overview of our offering. We're going to spend some time talking about due diligence today as well. So it's a hot topic in the real estate investing community. So we're going to spend quite a bit of time in due diligence. Leveraging your RSPs while keeping all of your tax shelter benefits, we'll speak to as well. And then, of course, next steps, if you guys are interested to participate and get involved, I'll let you know what that looks like. And at the end of the webinar, we will pause and do an open Q&A format. But just a reminder that if you've got questions along the way, please just go ahead and pop them into the chat. I'll check in on it periodically as well and just make sure that I'm not missing any questions along the way. So you don't have to save them till the end. Okay, great. So I want to share with you guys how I got started into real estate. So way back when, in 2006, Marty and I bought our first rental property. And we bought our first rental property in Guelph, Ontario. Now, this is a picture of the real house that we first bought. It was a semi-bungalow. It was $173,000, and it was and we created a 2-bedroom basement apartment, and we rented out the top floor for $450 a room. So way back when, we knew that we were in our early 20s and we wanted to get into real estate, and we understood the importance of saving for that first down payment, but also becoming homeowners and landlords within our first transaction. So we worked really hard to get into the market, and we were immediately achieving success with our first rental property. Now, because we were able to rent out for the rooms, by the room upstairs, we got top dollar for our rental at that time. And we quickly realized that we were living in a cash flow positive position. Which was great. It was a great place to start as a new homeowner. Now, we quickly realized that we had gained a lot of equity into this property, and we knew that if we refinanced the property, we could take out that equity and then go buy another rental property. So that's exactly what we did. Some of us call this a flip to yourself or a BRRRR strategy, but this is exactly what we had done way back when. And then we continued to do the same strategy again and again. We bought a single family home, created a 2-unit home, we'd refinance, pull the equity, and then continue. And this is how Marty and I had built our portfolio for many, many years as we started off in our career. And if you are new and starting off to your real estate investing career, this is an excellent strategy, even in today's market, for you to get into real estate investing. So this here is a copy of my vision board. So when the going gets tough, and sometimes, we're having stressful days or busy days while we're working our real estate career, it's important for me that I remind myself the reasons why I'm investing into real estate. And of course, why you invest into real estate is for money, right? Like everybody knows that. But what does the money actually get you? And that's freedom and time to spend doing the things that you really love and enjoy in life. So a couple things that are super important to me and Marty. So Marty's my husband. I'm talking about him like you guys already know him. So it's likely that you do, but if not, Marty is my husband and my business partner. We run Legend together. We've also got a wild and wonderful 3-year-old boy, Montgomery. So everything we do is building our life together. For us and little Monty, we like to spend time, in our backyard, roasting marshmallows by the bonfire, go fishing with the little guy, spend lots of time with friends and family. Patio hopping is something we absolutely love. And more recently, in the bottom left corner, there's a picture of the 3 of us kind of with a forest in the background. And we've purchased our forever home. So this is something that we've been working for over 20 years towards our goal. And real estate has allowed us the ability to buy our dreamland, and we will build our forever home. So this is me kind of opening up my heart to you guys and letting you know the reasons why I invest into real estate. But I want to hear from you guys. What is your why? What are the reasons why you want to invest in real estate? Go ahead and pop it into the chat just so I can get to know you guys a little bit better as well. I'm curious to see. Are you looking for legacy wealth? Do you have children? Are you close to retirement? Do you want to retire a little bit early? Do we have travelers in the room here as well? So tell me, I want to hear what is important to you guys. So surrender is financial freedom. Yes. Wouldn't that be an amazing feeling that if you have finances taken care of in your life, that you can really just focus on the stuff that you really love? Human is looking for reoccurring income as well, which is great. I completely understand that as well. So if you can get recurring income from a passive position, you are in a really fantastic place of life. And John, generational income. Yes, this is huge to most of us as well, that you want to be able to pass down generational wealth, work for it, for yourself, so that your loved ones are able to be, a little bit ahead and be able to enjoy some of those things in their life earlier. And for Christina, planning for your kids' education, traveling, and retirement. Yes, all of these things are absolutely huge. Imagine if you've got young children. So my little Monty is only 3.5 years old, but we're already planning for his education at this stage of the game. So we want to make sure that he's got as many options available to him, and that finances are not an obstacle, that if he wants to go to a particular education facility, that we want to make sure that he can do what he really loves. And traveling, most of us want to travel the world and see all kinds of places. This is the good stuff in life. and of course, retirement. So comfortable, safe retirement, so that you know you've worked for your whole life, and you want to make sure that you can really do all those things that you really want to do in your retirement. And then Wanda, build wealth, gain freedom, and leave generational wealth for your kids. Absolutely amazing. Completely agree with you. And you are not alone if these are the things that, are really the reasons why that you would invest into real estate. And then Leila, all what everyone wants. Yes, exactly. So what everybody else is already saying, completely get that. And then Paul, our ESP will limit your child's options. Beware. Yes, of course, there's restrictions for registered accounts, but also we have a registered account investing option at Legend. So even if you do have an RESP, you can get the most out of it and supercharge this RESP, self-direct it into a passive investment such as Legend for the targeted returns of 15 to 20%. We'll get into that a little bit later, but I couldn't resist just kind of talking about that. But yes, one component can be. So Leila, because I'm retired and I want to keep living well. Yes, I absolutely love that. So, just because you're in retirement shouldn't be that you have a reduction in your quality of life and all the exciting things that you want to spend your time on. So thank you everybody for sharing your why with me. That's really important. And it's good for you to remind yourselves that if the going gets tough and you're, working really hard towards your goals, then you need to recenter and say, why am I doing this? It's just a good exercise to keep in the forefront. Okay, so let's carry on to our next piece here. So your investing goals. So I want to know again from you guys, okay, we understand the reasons why we want to invest, and this is the good stuff, the lovey-dovey stuff. But how about your investing goals? What are you looking to get out of your real estate investing? Are you an active investor or a passive investor? Are you looking for short-term investments, or are you in it for the long haul? And how about cash flow? Are you at a stage in your life where you do want to be receiving cash flow? Or is this something that's not all that important to you just yet, and you would almost reinvest that cash flow and take it at a later date, more so for tax purposes? How about RSP eligible investing? Is this something that is important to you? If you've got registered accounts right now that are performing less than 15 to 20% annual returns, then I'm going to share with you an option that you might want to consider for your portfolio. And how about diversification? So most of us understand that you don't want to put all of your eggs into one basket, and diversification is an important component within your real estate investing portfolio. And how about a hard asset? Do you want to make sure that when you're investing that you can say, I'm investing into bricks and mortar, a hard asset that I can look at, I can see it, I can touch it, I know where it is. And risk tolerance is huge as well. So understanding your own risk tolerance on almost like a sliding scale is a very important component for your own investing goals. And how about flexibility? So we all know that life happens, right? So having flexibility within your real estate investing could be very important to you, again, depending where you are within your life stage, etc. So go ahead and pop into the chat. I'm again curious to see for you guys, what are your investing goals? What are you looking to get out of your real estate investment? So go ahead and let me know in the chat, and I'll pop over into there and have a look. Now, don't be shy. We already shared about our why. Grow your RSP. Yes, Monica, that's a great investing goal. So a lot of us, most of us have registered accounts. So growing that RSP in that tax shelter can be hugely advantageous for most of us. And at Legend, we do offer RSP investing options. So you don't have to cash out your RSP in order to invest it. You do what's called self-directing of your registered accounts, and you can put it into a private REIT such as Legend, or there's some other organizations that do that as well. And then surrender is cash flow with flexibility. I like that. So cash flow is a big one because you can't buy groceries with equity in your properties, right? You can't necessarily buy groceries with your registered accounts, right? So most of us at some point in their life, you're going to need to start drawing cash flow. This is how you're going to pay your bills. This is how you're going to go on your trips, your vacations, etc. So cash flow is a very important component, but having some flexibility with this is also something that a lot of us want to see when these life shifts start to happen. And Wanda's looking for long-term assets and cash flow. Excellent. So understanding that real estate is not a quick game. It's not just a short term, you're in, you're out. Most of us understand that real estate investing, you should be looking for, slightly longer term investments so that the investments can actually mature and produce greater returns for you. And then Paul is saying, we won't know what they're going to tax us at the passive income time. So we need to pay for this tax by increasing our returns to maintain lifestyle. Yes, tax laws, they can change over time. I would always suggest working with a really great accountant who is investor savvy, who can give you the best guidance into your different types of investing. So I'm not an accounting professional. I definitely lean on my accounting team to make sure that you are, utilizing tax strategy as much as possible so that it's how much you actually take home is very important. But increasing your income so that you can maintain your lifestyle is super important as well. So as we're talking about, if you're booking vacations and traveling around, you're probably going to need some cash flow in order to do that. So that's great. Thank you guys for sharing with me about your investing goals. So what is real estate investment and how does it work? It's new to me. So Chinello, so we are definitely going to roll into Legends offering for our real estate investing opportunities. So we will definitely get to those slides and we'll explain it fully. So as you have questions, make sure you pop them in the chat along the way. So today's commitment, what I'm going to show to you guys in the audience here is a real estate investing opportunity. So my commitment that I'm asking from you is that you commit to a yes or a no, but no maybes, okay? So the reason I say this is a lot of investors can get caught in this analysis paralysis mode. They're presented a buffet of investing options, and rather than making a choice and a decision and to say, yes, I'm going to move forward with that investment, they get caught in analysis paralysis or, held back by different obstacles and barriers. So my ask for you guys is to commit today and say, is Legend right for me? Is this a yes or a no? No maybes, okay? And what I'm going to show to you, if it's in line with your investing goals, which you guys just shared with me in the chat, and it supports your why, all those reasons why you want to invest, and it's getting you closer to those pieces, then I would, encourage you to make that decision and say, yes, I'm going to move forward based on the information that's shared with me today. So let's get into it. So at Legend, again, we are a real estate investment trust or a REIT, so to speak. So this is how we are actually structured. So at Legend, we're selling Class A unit shares at $10 per unit. We're targeting annual returns of 15 to 20%. And we're paying out a targeted 8% cash flow. Now, cash flow is paid quarterly, calculated annually. Our minimum investment is a $10,000 commitment, and we do have a DRIP program available. So the DRIP program stands for Dividend Reinvestment Program. So if you're one of those investors who wants to receive your cash flow, then that is an option. If you're an investor who does not want to receive cash flow right now, you can reinvest it into the fund at a 2% discount, and this is the DRIP program. Now, we do offer the flexibility that you could even go 50-50 for the DRIP program, and you can change your mind later if you have a change for your life situation. Investment vehicles are RSP, TFSA, LIRA, and of course, cash is accepted into our fund. And investor suitability, we're looking to work with eligible investors or accredited investors. So we work with an EMD, an exempt market dealer, and they go through all of the suitability to determine your eligibility status. So Legend's Edge. what we really offer to our investors from, a value proposition here is the ability to invest into real estate without any of the mortgage hassle. So at Legend, you can skip the hassle. You don't need a mortgage approval. You don't need a credit check. And you don't have any of these hoops that you need to jump through as you would if you were to go and purchase a property on your own. So it's very simplified investing without those, mortgage hassle specifically. And our investors enjoy completely passive, hands-free investing. So our investors get all the benefits of investing into real estate without any of the headaches or dealing with tenants or renovations. So let us do the heavy lifting. So Marty and I have done this for nearly 20 years and we're happy to do it. So let us keep doing the hard work and you guys can enjoy the passive hands-free investing. And as mentioned earlier, we are RRSP, RESP, TFSA eligible. So any Canadian registered account can be self-directed into Legend Real Estate Trust. And the exciting component about this is that you're not actually cashing out your registered account. You're self-directing it. And this is an important detail because you get to keep all of your tax shelter benefits while self-directing into a private REIT such as Legend. So quick highlight reminder, the targeted returns are 15 to 20% annual returns with that 8% cash flow payment is our offering. Just going to peek into the chat here just for a moment and make sure I haven't lost any questions along the way. Nope. Okay, we're good to go. So just a reminder, you don't need to save your questions. You can stop me at any time. I'll keep popping into the chat just to make sure. So let's go through a practical example here and a case study. Oh, I got a question. So we receive 15 to 20% annual return plus 8% cash flow. No, so 15 to 20% is the total return and 8% cash flow is a component within that total return. So that was a question from Andrea. So let's walk through an actual practical example so that you can see how we're coming to the 15 to 20% targeted returns. So remembering that we're selling at $10 per unit, which means if you do a $10,000 investment, you're actually buying 1,000 units at the $10 per unit. And the cash flow component is 8%. So this translates to $800 per year in cash flow, and it would be distributed quarterly. So you would receive $200 every 3 months. Or alternatively, you could do the DRIP and reinvest into the fund if you wanted to. But for this example, we'll assume that you receive your cash flow. In terms of equity growth, the equity growth, we're targeting that 7 to 12% equity growth. So this assumes that if we achieve that 12% growth, this means the units that you initially purchased for $10 per unit are now worth $11.20 per unit. So consequently, your investor portfolio would grow to $11,000 or $11,200 based on a 1,000 unit purchase. So we're going to combine those two ways that you're profiting for your investment. Combine that $800 in cash flow plus the $1,200 in equity growth gives you a total of $2,000 per year in profits. Now, if we fast forward to a 5-year period, $2,000 per year times 5 years is $10,000 in profits, and you have effectively doubled your money within a 5-year period. So I'm going to peek into the chat here and make sure that everybody's following along here just in case. So is non-registered accounts, how would you make the tax distribution more, or the distribution tax efficient? So it's a great question from Human. So again, I'm just going to remind everybody, I'm not an accountant, but we did have our accountants take a look at this component. So if you're a cash investor and you're receiving your cash flow payment, this is paid to you in a dividend. So this is already tax friendly from an investor component. Now, the first couple of years, while we own an investment property, we will have capital cost allowance that we can use from a tax advantage position here. So this means in the first couple of years, technically, the accountants say that we will do return of capital first. From a technical perspective, you're not actually redeeming any shares to offset that capital cost allowance. So because we're, a newer fund and we're buying new properties that we're putting into the fund, that will have that CCA that you can use to write off against the cash flow that you're receiving. So that is extra beneficial in the first couple of years for the investors. So we built it in the most tax efficient way possible, based on the accounting guidance, not me, but our accounting team. Excuse me. So what is MER? I don't know. What is MER? I'm not sure that I said, oh, maybe EMD. I think maybe that's what you mean, Verena. EMD is exempt market dealer. So this is my compliance officer, and we work with Equivesto. Excuse me. We work with Equivesto as our EMD. Oh, I misunderstood. So a management expense ratio. So that is not a figure that I've got at the tip of my fingers. I would need to come back to you guys and get the management expense ratio. Now, just for clarity, to make sure that I understand the question correctly, which management expense are you looking for here? Like property management, portfolio management? Because I can get that figure and follow up with you guys, if you want to let me know. Or do you mean like if you had a public market and you have a portfolio manager managing your assets for you, and they take a management asset fee? Is that what you guys are referring to? Ah, yes. Okay. Sorry. Thank you for the clarity. So there's no fees on this. So these are your profits that you guys are receiving. So if you invest, it's not coming out of your profits here. So as an asset manager, so Marty and I, who are the trustees within the fund, we do have asset management fees that are outlined in our offering memorandum. But I don't take a fee off of your profits specifically as we're paying out, as if a portfolio manager would do that. It's structured a little bit differently than, say, a mutual, so a mutual fund fee. Yeah, so that is not something that's applicable here. And I think I missed a question here from Paul. I'm just going to go back up. I don't understand 8% cash flow versus 15 to 20% total. What happens to the excess interest past the 8%? Great question. So for the cash flow component, so this means all of the income and all of the expenses for each property that goes into the fund will produce a cash flow component. So this is the surplus income. So all of our investors will get paid out up to their 8% cash flow before Marty and I get paid any amount of the cash flow. After we've achieved that 8%, your preferred return is what that's called. After that, investors will continue to receive 40% of the surplus of the cash flow. And this is not capped. So again, it's extra beneficial if you stay in the fund for even longer, because the cash flow will continue to increase over time. And then the 15 to 20% total, that is our equity growth. We're projecting that 7 to 12% annually. And this equity growth happens through mortgage paydown. It happens through just market appreciation as time goes on. And as we increase the income on our apartment buildings, this is directly correlated to the value of the building, and thus increasing the equity on each of our properties and within the portfolio. So we're targeting that 7 to 12% in equity plus the 8% in cash flow gives us the total return of 15 to 20% annually is what we're targeting. I hope that clears that piece up for you. Okay. And what is the minimum time frame for the investment? Are you able to cash out at any time, or are you locked in? Is there a penalty for cashing out early? So we're looking for a 5-year commitment from our investors, best case scenario. If you need to leave early from the fund, you can do so. This is called an early redemption, and there are some small redemption fees associated with an early redemption. So you're not locked out or locked in, let's say. We wanted to make sure that we built the fund with flexibility in mind. Okay, so moving along here to give an overview of our flagship property. So this here is 144 Lucan Avenue in Waterloo, Ontario. We purchased this property at 21,500,000, and our targeted closing date is at the end of 2024. So we negotiated the price of this property in December 2023, and we believe we got a really great price on this. Our purchase cap rate was at 5.3, and this is a 60-unit apartment building. So it's turnkey style, means it's completely renovated and it's already tenanted, and it will be cash flowing on closing. So it's an incredible investment in Waterloo, Ontario. When we have a look at the actual location, pardon my cat, when we have a look at the actual location of 144 Lucan Avenue, this is in a gentrifying, growing area that is a hotspot to many very important landmarks here. So we are 4 minutes to the Grand River Hospital, 6 minutes to Wilfrid Laurier University, 9 minutes to the University of Waterloo, 5 minutes to Kitchener Union Station, 7 minutes to University Avenue Station, and 4 minutes to Google Waterloo. So why this is so important to investors, and I hate to say it, but location is extremely important, especially for a 60-unit apartment building. So we've got a pretty diverse tenant profile that we can cater to in this location. Not only can we rent to students being near these education facilities, but there's also educational workers who could be really great tenants at our building as well. Hospital and healthcare workers would be excellent candidates to come and live at our building, and tech workers at Google as well. So this particular building is a step up than just, basic apartments. They have balconies, they have dishwashers, the finishes are beautiful, it's fully renovated. There's a gym facility in the building, and there's facial recognition security system to even get into the building. So it's a step above just a regular apartment building to cater to, a higher end tenant in this particular area. Oh, we got another question here. So what can be the various conditions that influence the percentages of 7 to 15% that you mentioned? So again, a very great question. So it'll be predictable that we will have that mortgage pay down that we're getting. So this the mortgage pay down each month that we pay the mortgage, it's going towards the principal payment. So we'll be able to actually calculate that out when we lock in our mortgage rate. So by nature of commercial financing, we won't know our rate of our mortgage until about a week before we actually close the property. So we've got a letter of intent right now with Peak Hill Capital, which is an A lender, a CMHC insured mortgage. And the rate that they've given us is bond yield plus 64 basis points. So bond yields are fluctuating daily, and they're on a pretty good trajectory right now. And we're expecting that we would likely come in below 4% for our mortgage rate. So that is one condition that will influence the 7 to 12% equity range, I think is what you mean here. The next piece is passive appreciation, just overall growth in the market. So a couple of influences in the location here is further development and more growth in the area. So right in our neighborhood, but also in the city of Waterloo. So Waterloo is growing. Waterloo is absolutely thriving and is said to be a tech hub in Ontario as well. So I'm sure we'd all agree that the tech industry is definitely industry for the future, and overall, being close to hospital and also education facilities, we expect to see continued growth in this particular market. And then also, as I mentioned, increasing the rents and the overall income at the building boost the overall equity and the value for commercial real estate. So we've got a strategic advantage with this property that 50% of it was built after 2018. So this means there's not rent control on 50% of the building. Even so, running our rental increases at 2.5%, which is the Ontario rate for this year and next, we're still increasing the overall value of our building. There's also newly built storage facilities at the apartment building that we can start charging for and boost the overall income. There's different size storage as well, up to bike storage and these larger units, and smaller storage to accommodate a different type of tenant as well. So those are the three main avenues. Again, the mortgage pay down, increasing income, and just overall passive appreciation within the market. So I hope that answers your question a little bit for you. And then we've got Andrea. So if I'm understanding that if the 8% cash flow is paid out, we've got 12% left in the investment, unless we reinvest the 8% at a lower percentage left in the investment, unless we reinvest the 8% at a lower percentage. No, so you've still bought. So for that $10,000 investment, I'm going to back up on my slide just so you can visually see. So over here, so with a $10,000 investment, you're buying 1,000 units at $10 per unit. So when you're receiving your cash flow payout, that's for you to receive. You have the choice to reinvest if you want. And if you do the DRIP program, you would actually be buying more units at a 2% discount. So your overall unit amount would actually increase. So then suddenly you would have 1,020 units, and then you would be getting that increase on a larger investment. Now, if you choose to receive your cash flow, you still have your 1,000 units that you've purchased that are growing within the fund. Now, the way they grow is through the equity growth. So this third column here, and through those channels that I just had described, the mortgage paydown, the income increases at the building, and just passive appreciation in the market increases the overall equity growth in our buildings and in our funds, and in turn increases your share value. So on an annual basis, at the very least, Marty and I will assess and analyze the portfolio value of Legend, and we'll decide, do we need to start selling our shares at more than $10 per share, because there's been that increase in value, that increase of equity within overall of the fund. So you don't have to reinvest, and you would still have your initial 1,000 units or however many you had purchased initially that will grow with the fund. That answers your question. And then Samantha, thank you for dropping my Calendly link into the chat as well. So if you want to book a one-on-one call with me, we've opened up our calendar over the next couple of weeks. You can book with myself or you can book with Marty. But let's go ahead and get face-to-face, and we can take an even deeper dive if that's something that you're interested in. Okay, thank you so much. And then let's talk a little bit about mitigating risk. So, oh, did I have somebody's hand up here? I don't know how to go back to that. Somebody raised their hand. Maybe that was a mistake. Sam, Christina, let me know if I missed something. Oh, somebody left. Okay, maybe they just hit a button differently. Okay, no problem. So mitigating risk here. So a couple of ways that Marty and I have mitigated risk within Legend. Now, to be clear, there's no eliminating risk. Like all investments, Legend also has risk associated with it. But what I want to talk to you guys about is how we've mitigated those risks and tried to reduce them as much as possible. So first on the screen here is no cash for keys, and we're starting at market rents. So this means we don't have to go in. Our business model is not contingent on us going in and doing cash for keys and doing evicting tenants in order to turn over each unit. Our rents are starting at market rents already. This building has already been renovated and it's already tenanted. We're starting in a cash flow positive position. We're very much focused on buy and hold turnkey properties within Legend. Our focus is to provide quality housing for working class tenants. So buying buildings that are already good is what we're focused on at Legend, and no large scale renovations. So our business model, again, is very much in the turnkey category, that it's not required that we're doing large scale renovations. We want to buy already built, renovated, newer buildings into our fund. And there's extra benefits of focusing on the turnkey style buildings. Vacancy is one thing that we don't need to tackle large vacancies during renovation periods. Rent control for newer buildings built after 2018 or after that in Ontario means there's no rent control. And of course, maintenance costs are quite a bit lower if you're in a newer building that's already been renovated. And our commitment to our Legend investors is to focus on one project at a time and to scale and grow the business at an appropriate and reasonable rate. So this could look like 1 to 2 acquisitions per year so that we're not cannibalizing different projects. We're not focused on developments at this time, so we won't be suffering development delays. And again, focusing on acquiring existing buildings is our strategy. And we have built our fund primarily on equity investors. So a small component can be private lending to just, facilitate a small piece within the business model. But focusing on equity investors gives that stability to our fund. And Marty and I have nearly 20 years. Oh, pardon my cat. I meant to lock her out, but she snuck in. We've got nearly 20 years of experience in the real estate investing industry. Okay, so I see we've got a couple. Oops, I'm just going to peek back into the chat here, make sure I'm not missing anything. How is my capital protected in the event of an economic recession? So this is a question from Tim. So Tim, what we're focused on here is that long-term buy and hold real estate. We're looking for boring and historically stable and historically more predictable type of real estate is where our focus is. We're not reinventing the wheel. We're sticking to the basics that we've always known. So in the event of a recession, let's say building prices come down just a little bit, then we hold. We don't need to sell our real estate. So that price really matters if we're trying to sell and dispose of assets. Where at Legend, we're very much focused on acquiring and growing our fund. We're not doing like large flips. We're not planning to dispose of assets and sell. We're very much focused on the buy and hold long-term game. And this is how our plans are to protect your capital within the economic recession. Also, if that were to happen. Now, also focused on multifamily properties, you've got, some diversity within your portfolio, and then you've also got some diversity within the overall fund as well. So as a Legend investor, you're not investing into one particular property, you're actually investing into a fund. So your investment would benefit from future acquisitions that we put into Legend. So that gives you some more diversity in mitigating that risk across your investment. And then I've got Sandeep here. Compared to your predicted $2,000 over year 1 with the mitigating risk, what would be the worst case scenario about losing the money and by how much? So, it's difficult to say what is the worst case scenario, I suppose. Again, we're entering into our purchase of a buy and hold property at 85% loan to value. So we're doing a 15% down payment into this purchase. We also negotiated our first purchase price last December when prices were low, and we bought at a 5.3 cap. So an incredible purchase point. So even since last December until now, mortgage rates have continued to come down. And we initially had written our pro forma at about an interest rate of 4.5%. So we're looking at a trajectory of being even lower for our interest rate and our financing on this building to be better than what we had initially projected. In addition to that, the rents and the income have continued to climb at this building while we're waiting to close the property. So we're in a very unique, advantageous situation with this initial purchase, and it's turning out to be, an even better investment than what we had initially targeted. So, what we're trying to do is mitigate risk as much as possible. In my earlier slide on how we're trying to mitigate that. So worst case scenario, you guys are coming in as LPs. So you are a limited partner. Marty and I are the GPs. So we are actually required to be the guarantors of the mortgage. So, our limited partners are the passive investors, the LPs within the project, and Marty and I are the GP, the general partners of the project, and we've been required to co-sign on that mortgage. So this comes with net worth requirements and the ability to, cover the mortgage in a worst case scenario. So once again, we've mitigated these risks as much as possible. And then Avijit, so how often are the valuations performed that impact the equity in the investment? Since this is your flagship property, how confident are you that you can achieve an aggressive growth projected, which is in line with other established REITs? So great question to ask here. So the valuations will be performed at a minimum of 1 time per year. And then also we might do it more often if there's been a sizable change within our portfolio. So for example, because we've had such a long closing period with the flagship property of negotiating it last December at prices when they were quite low, to the time that we close on the property, which, we're targeting for the end of 2024, that we're already going to have equity that is baked into this particular purchase. So this unique group of our, original Legend investors, you're able to buy in now at that $10 per unit. And, it's plausible that we might increase the unit price after we've closed our flagship property, just to have a real good look at the equity and to make sure that as we move forward into our second acquisition, that the unit price of selling for $10 per unit, does that still make sense for the fund? So there's, a chance that we'll do it with each acquisition as well. And, another point, just kind of going back to the recession component, that housing is still a requirement, even if we are in a recession. So, sticking to, again, the buy and hold real estate is, in comparison to, say, flipping or value add real estate, or even, development projects, these are more on the risky side of the real estate investing scale, as opposed to turnkey buy and hold real estate that we are focused on. So I just wanted to hit on that point there as well. And then Fenton, hi there, Fenton. So are the returns, i.e. cash flow and growth, depend much on the volume of investors? So no, not necessarily. So the cash flow is based on the actual properties producing the cash flow themselves. So we've got, our fundraising target in order to close on the property, which we're going to achieve. And then each property sits at the master LP level. So all of the income and all the expenses come out for that particular property, and then it gets kicked up to the fund and then distributed to investors. So no, the cash flow is not determined so much on the growth. The growth would happen as we're putting more properties into the fund for that, second acquisition or 1 to 2 acquisitions per year thereafter. And again, thank you, Sam, for going ahead and putting that our Calendly link into the chat there as well. If you guys want to connect with us one-on-one, we would certainly welcome appointments with you. So we've opened up our calendar over the next couple of weeks. So please go ahead right now, click on that link, make sure that you choose a time that works well for you. And you can connect with myself or Marty face-to-face on a Zoom call. And then Andrea, great question. How many properties are in your fund? So the Lucan property will be our flagship property. So it'll be the first that actually goes into Legend. So we're at this really unique position right now where investors can get in at the ground level, buy those units at $10 per unit, participate in closing our flagship property, the 144 Lucan Avenue. We've already got a couple options lined up or in the pipeline for our next acquisition. Marty is the acquisition man, and he's always scouring the listings. He was on the phone and actually working through some negotiations right now for a pocket listing in the area. So we've got our second one lined up. Now, don't confuse that with us being new. So although Legend is newer and growing, Marty and I have been investing into real estate for nearly 20 years now. So we're working on a go forward basis for Legend, and we're not putting our previous properties into the fund. So again, it's a great opportunity for you guys as investors to come in at this ground level, because it's $10 per unit right now, and it won't be forever. Okay. And then I've got another question here. I own multiple properties, and I do understand that interest rate effects on housing. Still appreciate your insight about the topic. So I'm not sure, is this a question? More so a comment there. Okay, no problem. Sorry, I'm just catching up on our chat here. A lot of great questions here. And then also, touching on our existing portfolio that we have. So again, Marty and I are very experienced investors, and many of our investors that we've worked with in our other projects have become Legend investors too. So outside of Legend, I've got 67 investors who are working with us on other projects. And in Legend right now, we've got 71 investors who have come in right now on, again, the ground floor and building this portfolio with us. So we've worked with investors for many, many years. We've got lots of investors who we're currently working with right now as well. And we would love to have you guys come in and participate if you think that this type of investment is in line with your investing goals and is going to get you closer to your why. And then Human, where would the second acquisition be whenever it's decided? So the second acquisition is not under contract right now, so I don't want to reveal too many details about it, but Legend is structured that we can purchase real estate all across Canada. So we will find our properties that fit in line with our business model, and that is the 15 to 20% targeted returns, and including that 8% cash flow payment is what we're looking for. The newer built, turnkey, renovated, tenanted, buy and hold multifamily properties is what we're focused on, and it could be across Canada. And then we've got some more questions here. So in the case of oversubscription, are the funds limited to your flagship property? Reinvesting into the fund as LP, are you restricted to this property, or can you be moved to other projects for GPs? So we're considered to be an evergreen fund. So this means that we can open and close fundraising as we see fit. So we will not continue so this is the dials that we need to adjust, right? So we're always balancing fundraising with acquisitions. So, you know, based on fundraising and how many investors we've got coming into the fund, once we achieve those goals in order to close on the flagship property, unless we have the next project in the pipeline or under contract, then we would consider temporarily shutting down the fundraising just for a short period of time until we have another project on the go. So we don't want to be in a position where we are oversubscribed, as you're mentioning there. So we've got that flexibility built into our fund that we can turn it on and turn it off. So, you know, we could then switch to, you know, commitments and people who are expressing interest to come into the fund. But there is a possibility that if you want to come in at this ground level, if you wait too long, the fund might be temporarily closed until we've got that second acquisition ready to go. So you would be subscribing at the master LP level. So this means your investment is not unique to a particular property, that you are investing into the trust and overall for Legend by design. And then Andrea, in your experience, does this face risk bankruptcy, or have you ever experienced bankruptcy in this type of work? If so, what happens to our investment? So it's a great question to ask. And no, I've never experienced bankruptcy ever in our entire career. And we have never lost $1 of investor capital ever in our entire career either. We pay our bills on time. We have no overdue loans right now, and we make all of our payments on time as well. So we've got a squeaky clean history in the real estate investing industry, and we've had no legal action made against us either. So no, we've never claimed a bankruptcy in this case. Now, your question is saying, well, what happens to your investment in the case of a bankruptcy? Well, we are the guarantors on the mortgage, but part of that comes with net worth requirements in order to qualify for a mortgage on this property. So we are in good financial shape in order to qualify in for this particular mortgage. We do own and manage and operate a sizable real estate portfolio that we've been building over the last 20 years that has allowed us to transition into this new purchase of a 60-unit apartment within Legend. Now, going through all of the risk assessments, this needs to be done by our EMD, so our compliance officer, and they go through the offering memorandum with you, the subscription agreements, the KYC, the Know Your Client form, so that you thoroughly understand the risks that are associated with all real estate investing, and in particular for this type of investment as well. So I would encourage you to go ahead and book in a call with me one-on-one. Let's talk about it, and let's get you connected with our EMD so that you can have all of these very detailed questions answered and satisfied for you. And then Fenton, is Legend purely Canadian, or will it be listed as a REIT with Canadian financial institutions such as Wealthsimple? So we don't have plans to be, listed as a public REIT at this time. We are considered to be a private REIT, and we are purely Canadian at this time, and we do not have we don't have plans right now to go outside of Canada. Canadian real estate is such an incredible investment right now when you're in the right markets and how you and navigating through these particular markets. There's huge growth and appreciation, and it's just a great business to be in. So we don't see a need to expand beyond Canada at this time anyways. And then Monica, what are the next steps to invest? So I'm just doing a little peek on time here. So how to invest, I'll jump forward and then I'll jump back if anybody can stay a little bit late. So you can use your RSPs to invest if you want to. So what that looks like is self-directing your account to an Olympia Trust account and then investing into Legend. You don't need to do any of this on your own. Your first step here is to book a call with us. So go ahead, click that link in the chat there as well to go ahead and book a call with myself or with Marty. We'll do a one-on-one. We'll talk about the investment, answer as many questions for you as possible, and meet you as well. We definitely want to meet you. If you decide it's something that you want to move forward with, then we will introduce you to Equivesto. So that's, again, our licensed EMD that will go through the suitability with you and determine what is your investment maximum. And then after that, you would actually complete your investment online. So it's a completely digital transaction here. It's smooth, it's easy, it's just one step at a time, step 1, 2, and so on. And we're there for you the entire time as well. So we've got an incredible investor relations manager. That's Samantha there, who's been helping us out in the chat here as well. She's happy to jump on a call with you and support you through your investing journey for the entire process as well. If you want to jump right over to the Equivesto portal, we've got the link there too. So Sam has dropped that in the chat. If you're familiar with this type of investing and you just want to go ahead and transact, then you can do that as well. But again, we would love to connect with you one-on-one on Zoom and make sure that we answer your questions. So just jumping back here for a moment into due diligence, I just wanted to give you guys this value of running through due diligence for investments, not only just for an investment like Legend, but if you're considering other investments to diversify your portfolio as well. We believe that these are very important questions that you must be asking before you move forward into an investment. First of all, what is the experience of the investment provider? Do you understand the project itself and how they intend to produce that ROI for you? And of course, what is the strategy behind producing that ROI?
I have a call.
Do you want to come say hi?
Sure.
Okay, just a moment. And then, of course, the legalities is really important to understand. Are there testimonials available? What is the reputation of the people who are producing this investment? And how about transparency as well? So, here's Marty.
Hello, everybody.
We got a great room of investors here. Lots of questions in the chat, highly engaged group here. So I just wanted to make sure that we give everybody this value here of this due diligence checklist, so to speak. And if you want to run through the answers to any of these questions with Marty and I, we're happy to do that. Oh, Wanda's saying hi. Leela's saying hi.
You got 23 people.
Yeah, we got a great group. We have a really great crowd. So if you want to run through the answers to any of these questions one-on-one on Zoom, please just go ahead and book in with us, and we're happy to go through all of these with you. And I see that Christina has dropped into the chat all of our social media too. So go ahead, make sure you're in the Legend Inner Circle if you're not already. It's a great place to interact with myself and Marty and just be a part of a free community of thousands of real estate investors. So it looks like, there's John, John Landry. I'm not sure which one.
I just saw that. I got a notification that John just booked in with me. I got like 4 people booked in.
Okay, incredible. Very good.
But I have a call right now.
Yeah, just a minute, please. So again, how to invest, book a call with us. We'll walk through it with you. It's super easy. Keep in touch with us. Of course, here's my disclaimer that our lawyer wants us to put up here as well. And that's going to be it for today. So reach out to us, guys. We're happy to help you build effortless wealth in Legend Real Estate Trust. So that's going to be it for today. Have a great rest of your day. Please keep in touch. Like I said, book in one of those calls with us. Thanks, everybody.
See you guys.